Hello, welcome to derivative session. In this segment today we are going to discuss about interest rate options. The previous videos we have already completed FRA, interest rate futures, which is mainly used for hedging interest rate risk. Okay, then what do you mean by an interest rate option? It's a financial derivative that allows the holder to benefit from changes in interest rates. So this is a specific financial derivative contract whose value is based on interest rates. Its value is tied to an underlying interest rate. Okay. Now, what is the difference between interest rate futures and interest rate options? In interest rate futures, you have to settle the contract even if there is a loss. Ultimately, it's a futures contract, okay? But in interest rate options, you have been given a choice. See, here you will be getting an option. You have the right to exercise it or lapse it if it is unfavorable to you. That is, option gives you the right but not obligation. You are the person who takes the decision, that is whether to exercise this option contract or not. It's a known fact that options are contracts that gives the purchaser the right but not the obligation. That is your choice. So here only right, not obligation. Okay. Okay, I will explain you with an example. Okay, you will better understand this concept. Suppose you are a borrower. You want to borrow money. You want to borrow money not now, after 6 months. So you approached a bank. Say it is ICICI Bank. Okay. So the case is that you want to borrow money after 6 months from ICICI Bank. Okay. So the interest rate would be 10%. Listen, interest rate would be 10%. And you may feel that what if the interest rate is not 10% per annum? If it is prevailing less? What would happen if the interest rate is prevailing less? It's a loss to you, of course. By that time, interest rate may fluctuate definitely. Because you want to borrow after 6 months, right? Okay, so the bank will offer you, that is, the bank will giving you a right that you can borrow from the bank with 10%. Okay? If prevailing rate is less than 10%, you can borrow at that prevailing rate. That is, the bank won't take any interest more than 10% from you, okay? So you are getting a right. That is, if you want to borrow, maximum rate would be 10%. If the prevailing rate is lower, you would be borrowing at lower rate. So you are getting a right. So you made an agreement with the bank. So borrower here got a protection. You are getting a protection from the bank. Bank is taking risk. So definitely this bank will charge a premium from you for offering this option. This is the case of option. Okay. Now let's have a look at the case of an investor. Suppose you are an investor. You will ask to bank that you want to invest an amount, but not now, later, maybe after 6 months. Okay. So the bank offers you that the interest rate on that deposit would be 9%. So you might feel that what if the interest rate prevailing is different? So the bank will say, if the interest rate is more than 9%, you can invest at that higher rate. So here what happens? If the rate is less than 9%, the bank will gives you the right that you can invest at the rate of 9. So here 9% is the minimum for investor. Okay. So here as an investor, you have a right to invest at 9% or the prevailing rate, whichever is higher. Okay. So no obligation here because you are an option holder, but you have to pay premium. Okay. So what we have discussed so far, in the case of borrower, we fixed an upper limit of interest, and in the case of an investor, a lower limit of interest rate is fixed. So this is what is meant by interest rate options. That is, the investors can speculate on the direction of interest rate with interest rate options. While explaining this topic, I have to discuss 3 more topics which is related to this concept, that is caps, floors and collars. Here caps means a cap is a maximum interest rate agreed upon in a contract. Floors, the counterpart to caps, that is, floors are minimum interest rate agreed upon in a contract. And collar, a collar is an interest rate hedging instrument that is based on the combination of a cap and a floor.